refill their coffee cup. I have a chance to do that. Oh, Tom Siver, I hear that you're confirming the audio as well. Glad you're here. For those of you who don't know Tom, Tom has spent most of his career in lending. In recent years, he's been with lenders who specialize in lines of credit for buy here, pay here, and other types of funding. So, I've gotten to know Tom well, have a lot of regard for him, and he's agreed to kind of sound off at the end and let us know, how he looks at indicators from a lending standpoint. Because I certainly don't come from a lender's perspective. I come from a dealer owner perspective and look at portfolio performance and cash flow. And obviously, we're trying to get the portfolio to perform as well as possible. But what a lender might choose to look at in that regard may be different. Might be different terminology, might be different ratios. But those are things that we're just not used to seeing. And I don't work very much, by the way, while we're waiting to start here. I don't work very much with dealers' financial statements. We don't see the operating expense side. We're working primarily in the DMS, and so the numbers we work from are really going to be numbers pertaining to the performance of the portfolio. And of course, we see sales and inventory information, but we just don't see the P&L or the operating expense side of the dealerships very often. So again, this is where Tom will be helpful to us. So glad he's able to join. So let's go ahead and get underway. I've got, we're going to talk about the top 7 go-to indicators for portfolio performance in buy here, pay here. And, we also could talk a lot about indicators for performance over on the sales and inventory side, but that's not our purpose here today. For today, we're just simply talking about those indicators pertaining to how well our portfolio is performing. So looking at collections really for our purposes today. Now, who is Octane and who is Jim Rhodes? We're a consulting firm originally based out of Salt Lake City, and we're 100% buy here, pay here. We work with buy here, pay here dealers only, or finance companies that are also just another way to finance buy here, pay here contracts. So we're very much in subprime and exclusively in the buy here, pay here business. We do training and education. We've done some turnaround work. If you've got a dealership that's underperforming and struggling, we've done complete business turnarounds with clients. So that's also part of what Octane has done. We do data analytics. And I mentioned down here on my own little section that, I calculated not long ago that dating back to 2000, when I first started doing consulting, I have now done weekly numbers for some clients somewhere for over 1,000 weeks in my career. And I just doubt that there's anybody else in the industry that could say that. I've been looking at weekly numbers, across the country for some dealer somewhere for many years. And so, we have a pretty deep understanding of, how portfolios work and how cash flows in the buy here, pay here business. As a consulting firm, we also are specialists in launch packages. We work a lot with dealers starting from scratch, and often dealers are not from the buy here, pay here business or the car business. So we're helping them get in the business from zero. And so that's work that we really enjoy. And that's a big part of what my career has been. As a consultant, trainer, and author, some of you have seen my articles in NIADA and other state publications. Many of those are available at our website, by the way. And then I have both management and ownership experience. I started out in management and buy here, pay here. I owned a dealership myself for 7 years in a related finance company. And so I've been on that side of it as well. I've been in the buy here, pay here business counting back to when I started managing 23 years, 20 of that as a consultant. And with the work I did with a software company that was also a consulting company in Florida, and the work I've done independently since, I've now been in 26 states professionally. And again, I just think, that's strictly buy here, pay here. So, we've been down in the trenches with buy here, pay here dealers. And I often say when I go out and do those on-site visits, I tend to learn as much as I teach. So, there's just a lot to be said for having been in the weeds with dealers and being out there with the managers in their facilities. So that's part of what we bring. My early career was sporting goods and sales management, and I did work in a franchise store for a couple of years before stepping into buy here, pay here. So that's a little bit about me. Let's jump into today's material, and that's really about how the number 1 out of our top 7 that we will cover is going to be collection efficiency. And if you go out there and search on the web, you may not find anybody else referring to the label collection efficiency except Octane. As far as I know, we're the only ones that call it that. And we track that as a way to identify how well we're collecting compared to what the portfolio was projected to bring in. And this is the number one thing. And I would say that if I'm going to go kind of slow here, because if we only covered this number one objective, this would be probably the most useful thing that you could learn from us. And this is one of the numbers that I have tracked for those 1,000 weeks. So why is this one so important? Well, I first have to help you understand exactly what it is that we're measuring. In order for you to really get down to this number in the way that we do, you'd be counting on your software, your DMS, to produce this information. And it's really about having the dollars that are contractually expected from the customer. So you can look at this, we look at it on a collective basis. You can see from the snapshot of the report that I've got here, this is from an actual client that you're seeing on the screen. So when we look at that, we look at an aggregate, or on a weekly basis, we look at the entire portfolio and look at what is the portfolio contractually expected to bring in this week. So again, I'm going to go slow here. If you think about a customer who has a payment of $100 a week and they're behind, they may be $150 past due or whatever. But irrespective of their delinquency status, we look at the report and it says that customer, according to their contract, is supposed to pay $100 this week. And that's the number that becomes very important. And we need to be able to get to that in the DMS in order to be able to really produce this in a way that's comparative to other clients. So we look at that number and we say, okay, the portfolio is projected to bring in, and let's just go over here to this particular client. You can see this is 164 weeks. We've now got 4 years worth of data with this particular client, but let's just look here on the last row. Hope you're seeing my cursor there. On the last row, that was a week ending in December of 2019. The portfolio was contractually expected to bring in 148.7. We actually brought in 146.6. So that says for that week, we collected 98.6% of what was contractually expected. So again, this is irrespective of what's past due. That's irrespective of any customers who may be paid ahead. This is just what is the portfolio supposed to produce for this particular week. And now we come back and measure, okay, how well did we actually do in terms of putting money in the bank? Now, I might point out this number says it's filtered. That's a really important thing, because if you ran this number yourself, it's probably going to look much higher than what this dealer's showing. This dealer's showing, you can see across a 10-week rolling average, they're at 94.1%. It's very strong. When we think about poor credit consumers, and we look at that and think, we can keep this our little secret, by the way, that dealers are able to collect 94% of what they're contractually expected to bring in from poor credit consumers, then, I think people outside our industry would be baffled by that, to actually collect most of what you're supposed to collect from these poor credit consumers, because they all have bad credit, right? And so it's surprising that we can collect that well. So there's keys to how well, or how we're able to collect that well. But for our purposes here, I would just say when we filter it, what we're doing is we're removing unexpected money. So if you think about a customer who has an accident and State Farm mails you a check for $8,400, it's great that we got that cash, but we don't want that to pollute our collection number, because we're really trying to look at what did we collect compared to what we expected to collect. So this money would be kind of what we would call unexpected money, and we filter that out so that we're really looking at how well did the collection team do. Because without that, you might think, well, we got that 8,500 in, so our bank deposit looked good and we collected well. Well, in fact, if you pulled that number out, you didn't collect as well as you thought, because, as far as we collected from what was expected, then that's a different number. So again, there's some work involved with getting to that number, but filtering it is important, because now we look at what's really, being collected compared to what was expected. And so now you begin to see why I might say this is the number. If I were to pick one number to compensate collectors and to compensate managers who are supervising collection department or have collection responsibility, and of course we can argue that a general manager in a buy here, pay here operation, collections has got to be job one in buy here, pay here, across all spaces. So this is why I say that, collection efficiency becomes the important number. It's the go-to number for me. And so I sort of de-emphasize delinquency. Some of you might have expected my number one go-to to be delinquency. And delinquency on my list is farther down. So we'll talk about that. But again, collection efficiency just looks at what did we collect compared to what we were supposed to collect. And that tells us that we're getting money in the bank. Now, I would stop to say that, we can still do well with this number and still be experiencing some repos and charge-offs. Why is that? How could that be that we would have a number of charge-offs and still be collecting well? Well, it's because if the contract stops performing and we move the repo through the process quickly and we charge the account off, then it's going to quit appearing in these projected figures, right? It's not going to be expected payments anymore. So this is another indicator why I like this number, is because we can't have a high number of non-performing contracts in the portfolio and have this number still, track out well. So again, there's lots of reasons for me to choose this one as number one, but I would say if you're performing well on collection efficiency, then odds are all these other numbers that people refer to are probably going to be just fine. Now again, you can have high collection efficiency and still have a high charge-off rate, but at least your portfolio is clean. For this particular dealer to be collecting 94.1%, that says they don't have a lot of what I sometimes call dead wood in their portfolio. They don't have a lot of non-performing contracts that are sitting out there. Repos have been on the back line for 60 days, but the account's still on the portfolio. That's dead wood. That's a non-performing contract. And if it's still sitting on your portfolio, this number is not going to look like 94.1% for some dealers. So that's why, we say this is a really important number. It really tracks, how well your portfolio is performing compared to what it's contractually expected to bring in, which also becomes an important cash flow projecting tool. One more thing that's really important for us in buy here, pay here. It's one thing to know what we're collecting now. It's another thing for us to be able to project the next 60 to 90 days of cash flow and be able to plan our buying and, maybe our hiring decisions and a lot of those kind of things off of that. So when we get settled in on this number, and you can see, again, this dealer's got lots of history there, but we look at it on a 10-week rolling average because it's going to be up and down. You can see with this particular dealer, here's a 92.9% week. Here's a 100.8. So we look at it across a range and we say across, 10 weeks or more, we would expect to see that number come in at 93% or above. Okay, so let's talk about that. That seems really high, doesn't it, for buy here, pay here? If you're not used to tracking this number, 93% net or 93% filtered is the number that we suggest to our clients that they should be able to achieve. And we just have a lot of experience with that. And it says, we know that a clean portfolio should really produce in that level. So let's talk about the missing 7%. When I go out and meet with a dealer, I often ask them to think about, if I say 93%, where's that 7% missing? And I'll wait for them to answer and think through that. I'll let you do that for just a minute here. So think about, if we're only collecting 93%, what happens to the other 7%? Where does it go? How come we don't get that money in the bank? Well, the two answers for me would be, one, that customer that doesn't pay, we ultimately repossess, and maybe it's a few weeks before we charge off the account and write it off of our portfolio. Well, for every $100 that was supposed to be coming from that customer each week, that was contractually expected, we didn't get it. And so now we charge off the account. And now those payments that we expected during that period of time didn't make it in the bank. So we recognize that that's one source, right? That's easy to identify, that repos, non-performing contracts are going to contribute to some inefficiency or to that deficiency. Now, if we think about the other way that those dollars could be missing, so to speak, is that if we took that same customer who was supposed to pay $100 a week, we didn't get it, we brought them in the office, we ultimately recontracted them, or maybe we just deferred their payments and moved them to the end of the note. Well, in that case, those dollars that we contractually expected for that period, even though you can argue I'm still going to collect them at the end of the note, the reality is we didn't collect them during the time period that we're measuring. And it doesn't help us pay our utility bills right now or meet payroll right now. It's money that we expected during this time period. We didn't collect it. And so we're deficient in that regard. So I would say, if you can limit those two things, obviously repos, we're all trying to limit, but if you can limit deferrals, then the rest of the money should come, right? Because even though the customer's delinquent, they catch up, they pay an extra 20, an extra $50 here and there. And so across, a 6, 8, 10 week range, we should collect 100% of those payments. That's why we think 93% is really the number. So again, if we can just avoid those repossessions, which we're all doing all the time, I hope, and then we avoid those deferrals, then the rest of the money we think should be in the bank. And that's what we can now build our cash flow performance based off that and do projections accordingly. So again, we'll come back to that. I know that's a little bit in depth. In fact, let me just make sure I didn't miss anything on that before we go forward. It indicates cooperation, which means flexibility in working with customers. And you can see why you could still have delinquency in this scenario. And often with my clients, I chart both collection efficiency and delinquency on the same chart, because delinquency can be running kind of high. It'll spike and be up and down, but collection efficiency just plugs along and we still put the money in the bank, even though the customer is running past due. So this is part of why I don't like to see us compensate collectors based on delinquency, because that's demoralizing. And if we're cooperating and working with customers and helping them keep in their cars and keep making payments, then delinquency will be a fact of life. And I would say that if our collectors are getting the money in the bank, even if it comes a little bit late, they're doing what we ask them to do. And this is why I think they should be compensated on collection efficiency more so than delinquency. And delinquency can be demoralizing in our line of work. So it's a tough thing. It's really contributes to problems in longevity with good people. And so we just have to be careful in that regard. Let's move on to principal conversion rates. Now, conversion rate is my label. It's what I call the rate at which we convert our portfolio into cash, or in some cases, we convert it into charge-off. So in this case, we're looking just at the principal amount in the portfolio. So what you're seeing on the screen here, this chart shows a 6-month rolling average. So in other words, if you took the percent of opening, and this just basically says the green line is collected principal. So we'll measure it each month. Okay, the portfolio opened the month with 11.2 million in principal. We collected 473,000 in principal. And so now we do that measurement. Okay, what is that ratio? As a percentage of where we started, what did we collect this month as a percentage of our opening balance? And then we track that on a 6-month rolling average. So you can see this particular client started out where their charge-off principal and their collected principal were running very close. And I wrote an article on this not long ago about how these ratios really need to be, there needs to be some separation between these. We really should be collecting more principal than we're charging off, right? That just seems pretty logical. And so what we do then is we track that, and you can see where this client began to really widen that gap. They're now collecting far more principal than they're charging off. So again, that's why we like to look at that number against what I call a conversion rate. There are, in the financial world, they look at these ratios in different ways. You'll hear reference to loss to liquidation ratio and collateral recovery rate, and those are interesting. But to me, for us in day-to-day management, this is what we're really looking at. How much did we collect compared to where we started? How much did we charge off compared to where we started? And then the next thing for me would be, this kind of collateral recovery rate would be the relationship of those two numbers. You can see that in this particular case, just for the date range that I've measured, and this is actually the same client that we looked at on the prior page, but this is the more recent snapshot. This is actually through November of 2020. And you can see that they, in November, they collected 3.9% principal. They charged off 1.9% principal. So the ratio of that is 196%. So this is a number that we want to watch. And even though this one's got an average of about 140, we like to see that number with most of our clients run closer to 200%. And you can see that in recent months, they've been in that 200% range. But again, it's not the same label that some folks in the industry, certainly Wall Street, might call this something different or measure it in a different way. We're just simply saying, how much are we charging off? How much are we collecting? How do those things compare? And you can see why we would say that's indicative of your portfolio health and how it's performing. It's also going to be indicative of the cash that it's throwing off. It's why I call it the other conversion rate. It's the rate at which we take those receivables and convert them to cash. And so these are better indicators. I didn't even talk, and I'll kind of give you a spoiler here. I don't even have static pool in my top 7. People talk about static pooling, and it's interesting, it's helpful, but it's sort of like getting your report card, at the end of a semester. By then, it's too late to change your grade. That's kind of the way I think about static pooling. It's like if you measure your portfolio all the way to maturity, yeah, for a well-established, mature operation, and you're looking at years worth of data, then static pooling is helpful. But for those of us that are newer in business or have a growing portfolio, or maybe we've changed our business model a little bit, we really need to be looking at more real-time data. We look at a lot of weekly stuff. We look at certainly monthly stuff, and we want to be able to make judgments now based on how the portfolio is performing now. So that's why I don't it's like we'll call it a midterm report maybe instead of a end of the semester report card. It's we want to know how we're doing now so that we've got the opportunity to take corrective measures and improve what we're doing. So that's why you don't hear me talk much about static pooling. It's kind of after the fact, and it's old information. Let's move on to number 4 out of our 7 top indicators. Number 4 would be collected principal and interest per active account. So this is an interesting graph that you see here. The green bar represents the average for this particular dealer. And now we just look at, okay, how well are we collecting? And you can see this is a weekly number that we're tracking, and you're seeing a 10-week rolling average. So now we look at, okay, of all the customers in the portfolio, we just do a comparison of we collected this much principal and interest this week. How does that compare to the number of accounts that we started with in the portfolio to start that week? And then we just track that number every week and look at that on a 10-week rolling average. And it's another way, we're just slicing the same piece of pie in different ways, but it gives us multiple perspectives on our portfolio performance. And this is simply another one that suggests, you remember the chart that I showed you where the dealer was starting to increase their collected principal compared to their opening balance. And here's another one that says, okay, we're collecting more principal and interest per active account. So you can, it's easy for us to understand why that would be important. We want to make sure that we're collecting a good amount of P&I per active account. And then we want to go back and kind of compare that to the green bar, which is our average. We just update that average periodically and look and see, how we're doing compared to our average. So again, just one more way to look at the same thing. Let's talk recency. Most of you who've been around the buy here, pay here business very long are familiar with recency. I track it for some clients. You can see it's number 5 out of 7 for me. It's not a high priority. It's because, and you can see why my argument that if we're doing well in collection efficiency, we're probably also doing well in recency. So it's something that I kind of push to the back burner. It's on the second page of the report, maybe. It's a number that we like to keep an eye on, but we feel like we'll be doing well in this number if we're doing well in collection efficiency. So what is recency? That just simply means how recently the customer has paid. Now, across the industry, I find, and certainly up there, at the top of the industry amongst the financial folks in this segment, they tend to look at recency across the entire portfolio. So, if you're an established operation and you got 1,500 contracts, they would look at, okay, out of those 1,500 customers, how many have paid in the last 14 days, how many have paid in the last 30 days, or however they choose to break it down. I don't choose to do that. I don't particularly care, and I think it slants the numbers too much. I don't particularly care how recently the customers that are current have paid. Most of your portfolio is probably bi-weekly. So if 70% of your customers have paid in the last 2 weeks as expected, then it's obviously going to skew the data an awful lot. So when I look at recency for my clients, I look at how recently the customers who are past due have paid, only past due. So that's why you see this, and this is just one segment that I've shown an example chart where we show, and this is actual data from a recent client or from a client's recent data. And so what we're showing that particular dealer is of your customers that are past due, this is how many, a count of how many customers have not paid in the last 25 days. Why would that matter? Because these customers are the ones that are our next set of charge-offs if we don't get a resolution with that. So this is why I choose to just drill down and look at recency of past due only. Let's look at, of your past due people, how many have paid in the last 10 days, et cetera. And we break it down differently for clients. With most of our clients, by the way, we run data on Sunday. So a lot of our selections are based on the fact that we're capturing data on that interval. And so we chose 25 days in this case. So that just tells you that customer, if they haven't paid in the last 25 days, of course, if you're looking at a bi-weekly cycle, they would be paying every 14 days. And so this customer is in danger of falling into your charge-off list if we don't hurry up and get that customer resolved. Again, that's why we choose to look at that one in terms of recency. Let's talk delinquency now. So delinquency matters. Even though you've heard me say collection efficiency is the higher priority for me, we still need to keep an eye on our delinquency. But look at this particular client. This is the same client where I showed you the data that run 94% collection efficiency. This is again a Sunday number, but they're averaging 26% delinquency. That's, by the way, 1 penny late, 1 day late. We're not like the big banks that look at 30-day delinquency or 5-day delinquency. No, for us in buy here, pay here, when we say delinquent, we mean the customer didn't pay yesterday, right? So we're looking at fresh delinquency, total delinquency, and this is again a Sunday number. So this particular client is running 26% as an average. More recently, they've done better than that, but you can see that that's their actual. So let's look at this is fairly fresh data, 12/13 of 20. They started the week with they closed on Sunday with 11.2 in their portfolio. They had principal past due of 2364, which came out to 20.9%. If we look at their 4-week rolling average, it's here. If we look at their 10-week rolling average, it's here. So that again is based on dollars. I know that's kind of an industry standard. It seems to be to look at dollars as a comparison. But if you go down here and look, I do the same thing with accounts. We look at, okay, this particular portfolio had almost 1,700 contracts active at the close of December 13. They had 374 customers past due of just $1, 1 penny late, and that calculated for that particular week to 22.1. You can see across this range, that's bottom line, it's not too different in terms of number of accounts, especially with a portfolio this size. It's not too different in terms of accounts versus the number up here in dollars. So why do we track both? Well, for me, having been around this business a long time, what this 374 represents to me, it's not, we can still be collecting well, but when I see 374 customers past due, to me, what that indicates more is a management question, is how much manpower do we have to devote to managing that many customers that are past due at any given time? So that's why I choose to also look at the number of accounts, because we just know that that's going to be an indication that we need to be keeping an eye on our staffing and number of collectors we have on hand, how much effort is going to be required, maybe how much overtime might be required this week. But this is why I think delinquency, we need to keep a lid on it. I like us to be flexible and cooperative with customers, which means we're going to experience some delinquency. Some of you can find the video I did on YouTube not long ago that talks about a 10-year approach to collections. If we treat every customer like they're going to be with us for 10 years, then we're going to be more flexible. We're going to be more cooperative. We're going to get past the hiccups, and we're going to have some customers on the past due list. And this is why, I choose not to frustrate collectors by paying them based on delinquency. I expect they're going to be cooperative and flexible with customers and get them paying and committed to some sort of payment extension, payment arrangement, and get them caught up. But that just means they're going to have some delinquency if they're using that approach. So again, number one was collection efficiency. You can see I've got delinquency all the way down here at number 6. It still matters, but it's just not as important to me as the other. So let's move on to number 7. This is our last one, and this one's going to be a bit of a surprise for some of you. This is a little bit of a departure. When you're looking at collection performance, portfolio performance, and portfolio yield, I'm going to ask you to look at these numbers down here in the green. So what you're seeing on the screen is the actual cash flow tool that I built for use in helping clients project their capital needs. Okay, so and ignore these numbers over here because this is just one model, one example that we ran, one scenario for a dealer. But it factors in overhead and all these kinds of things. But what we do then, if you look down here in the sections in green, think about a dealer who's coming out of the franchise business or the retail space, and now they're stepping into buy here, pay here for the first time. There's a paradigm shift that has to happen, and we have to ask dealers to get used to thinking differently about cash flow and buy here, pay here. It's not about sales and gross profit, it's about cash flow, which means these numbers in green tell us at the average payment that we've got up here, $376 a month, and at the overhead that this dealer's got listed, the portfolio would need to have 33 paying customers at $376 a month in order to cover overhead. Okay, so what I'm suggesting is that if you really want a performance indicator on your portfolio, you really need to know, and this number will vary, I would go back and look. And some dealers choose to look at it with down payments factored in. Some of them just look at installments. I'm good with either one. I like to look at installments only just to know how many customers we really need to have. But I feel like every dealer in the buy here, pay here space needs to know, what is that number? How many contracts do I need to have paying, active performing contracts, paying whatever my average payment is to cover overhead? So we should know that number. If that's 53 contracts, if it's 47 contracts, whatever that number is, we need to know how many customers need to be in the portfolio and paying in order to cover first overhead. Then the next level would be covering both overhead and the cost of replacing inventory. So you see, I've got inventory replacement listed down here, and that takes another 216 contracts. So again, this is not the way that a franchise dealer is used to thinking. They're thinking gross profit, volume, sales, right? That's what the business they come from. But we have to ask them to think about cash flow and how many contracts you need in the portfolio. So this particular dealer would need 248 contracts paying $376 a month in order to cover the cost of replacing inventory at the cost and reconditioning that we've got loaded in there. And at the payment amount that we've got loaded in there, that we need 250 contracts. So again, this is sort of less about portfolio performance, I suppose, and more about operational performance. It's, do we have, how many contracts do we have paying, and how does that compare to our cost of operating? This sounds fairly straightforward and simple, but I just continue to be amazed at how many dealers I meet who don't really think in these terms and don't know those numbers. And so I think, in order to get cash positive and begin to start putting cash in your pocket, I think we've all been to these conferences where we hear these dealers that have these multi-million-dollar portfolios and they're still out there looking for cash, and I'm thinking, have you thought about just focusing on getting cash positive and putting money back in your pocket? I mean, that's really kind of where my head comes from. And so that's kind of the way I choose to think about this particular business. But again, this is just about thinking about, know those numbers, and what those numbers will be will vary depending on operation. But I would urge you to know those numbers as a component of knowing, how your business is really performing. So that covers all 7 of the top points. I hope you're going to find those useful. I've got a quick offer to share with everyone. We're doing a free analysis, and you'll say, why free? Well, the Octane Group has motivation in having this data available to be able to have comparative information to share with other dealers. Now, it's going to be totally confidential. So you share your numbers with me. We're going to put it in a raw data pool. It'll have confidential IDs associated with it. So nobody's going to know it's your data, but then you're going to get back a slick report. When you contribute your data, you're going to get back a slick report that basically will show, and I've given a quick example. I can probably jump over and show you a screen. It's got more graphs, but we're going to do delinquency and recency breakdown as of December 31st. We're going to do a loan structure comparison, at least on the accounts that are in the portfolio at the time of December 31st. We're going to do a notes receivable breakdown. Again, all comparative data. So I'm just giving you some examples of what might be in there. Here's some recency information, delinquency not paid. We're looking at average term in months as an example. So these, again, just a couple of examples of, it's probably going to be 15 to 20 graphs that you would get back, and it'll show your number as compared to the group low, average, and high. So again, we would invite you to send that information in. Now, all we need for you to do today in the webinar is just, send us a note, send us an email, send a message in the chat bar here. If you're interested in participating, just send us a note, and we'll reach out to you by email and tell you exactly how to submit the data and how to participate. But again, it's totally free to you. You're going to get comparative data, and so we hope you would find that useful, and we hope many of you will participate. So again, just reach out to us in whatever way, email. Here's my email. There's my cell phone. You folks are welcome to call or text me directly at any time. But that's where, we want you to just let us know exactly if you'd like to participate in that, and we'll be happy to get you included. So that's really all I have for today's presentation. I'm going to open the microphones here. I'm going to check the message panel and see what we've got for questions. Bear with me just a moment while we get that done. Great participation today, by the way. I'm glad everybody took the time to join in. I'm not seeing questions in the chat panel. You can also raise your hand, I believe, in there, and I can open your microphone if you have any particular questions or feedback. If we've got any questions, I'll field those before we get Mr. Siver involved. Are you still with us there, Tom? I see you. You show to be active. I see your question there, Herman. Yeah, we'd be happy to email the presentation. Happy to share that. So yeah, I've got your email address already. And then let's see. Thanks for the feedback. I see that. I see, David, you're asking a question about Frazier. Unfortunately, Frazier is one of the systems that I've had trouble getting this actual projected information from. So we have to use more like an average, which is not my favorite way to do that. But I think you and I talked about trying to reach out to Frazier collectively and see if, because I have other clients on Frazier who would benefit from that. We'd like to get all DMS providers to be able to produce for us this exact report. So yeah, let's by all means try to reach out to them and see if they can produce that for us. Amanda, I see your comments about requesting a copy of the presentation. Happy to do that. I'll make sure I'm not missing any questions, and then we'll open it up for Tom Siver. You get you opened up here, Tom. It shows we need to send you an audio pin. Maybe that means you're on the phone instead of on the meeting. Hopefully you can use that audio pin to join. One moment. Sent the audio pin again. Hopefully that'll let you get joined in. In the meantime, I'm going to keep looking at the questions here, make sure I haven't missed anybody. Nice feedback. I appreciate that. Hope you found it useful. And okay, here's a question from Stephen. What concern should we have if our current is chronically only about 75%? Let me make sure I understand your question, Stephen. Now, if I read it exactly the way you've written it, what concern should we have if our current is chronically only at 75%? So in other words, I would say that differently, like 25% delinquency, but 30 days, whoops, screen moved, what I was reading, even out to industry averages. So yeah, it depends on what day of the week we're measuring that. You know, I hope I can answer your question here. It varies a little bit depending on operation, but if you're running 25% delinquency, I think you saw by the charts I showed you that that's not outside the industry norm for me at all. I would anticipate that. It depends a lot on our collection approach that we adopt in the business and how flexible we are with folks. But yeah, a 75% currency or 25% delinquency is not any kind of concern for me. I see most of my clients running in that range. In fact, I would probably say if you're running, I hear clients talk about, running single digit delinquency. The skeptic in me says we're either missing some business, we're not doing business with as many folks as we could, or we're manipulating a lot of accounts. We're doing a lot of deferrals to move payments in order to have that kind of low delinquency. Otherwise, we'd just be brutalizing the customers and demanding that they pay. And if we do that, I'm afraid not very many of them are going to make it to the end of the contract. So that's not the approach I would be recommending. So again, because I teach flexibility, I would say a 75% currency is perfectly healthy and workable. Trying to come back to you, Tom, but I don't see that you're. Let me see if I can get you in there. Oh, here we go.
Can you hear me?
I got you now. Yeah, I opened your microphone just now. So we might have the others in the group verify they can hear you, but I can hear you just fine. So let me just ask you first your thoughts on what I presented. If you have any thoughts about what we're asking dealers to look at, and then share with me what, from a lending perspective, what you might like to see in addition to what we talked about.
Yeah, thanks for putting this on, Jim. Some great information. I'm very much into data and looking at different pieces of a business. Obviously, from a lender standpoint, we look at financials, but a lot of that's driven from cash flow. So we do a cash flow analysis. Unfortunately, I see a lot of guys where the financials, their CPA, they don't quite understand this business. So that's a challenge. But if you go back to a cash flow analysis, generally I can get into whether I think there's a viable deal here or not. CRR, interesting enough, is that's one that we actually look at currently in tracking. And I would say those are probably the two biggest things, because a lot of that's, will ultimately be driven through the financial piece of it. I do have clients using your stuff, and I loved actually the net collection efficiency piece of it, especially during this year when we've had such a downturn, or we thought was going to be a big downturn. I actually used that ratio that you provided the clients we got and monitored that to ensure that we weren't going to run into issues, since it was being sent out weekly. And that was a great indicator to show me that this guy had plenty of cash and was collecting enough cash to get through his month and survive. So I don't know that I have anything necessarily that I would add in addition to this stuff, because I think some of the stuff that I look at and go through kind of all relates somehow into the information you presented here as well.
Right. Good. Yeah, I appreciate that, and I recognize, like I said, we don't see the financial side of our dealerships very often. I mean, sometimes we're called in on a certain kind of engagement where we would get into the financials, but typically we're working more from the DMS side. So we're kind of specialist on, portfolio performance as we can see it from the DMS. But yeah, I appreciate you joining in, and I think, folks, you can anticipate that Tom and I will probably co-present some of these things going forward. In particular, we'll dig into some things on financials and some other indicators that people need to be aware of. I'm going back to the meeting panel. Tom, I'll come back to you in just a minute. I'm going back to the meeting panel. I see that a couple of you had questions about use of capital, and we can certainly cover that with you, Luis. I see your question in there. I can probably cover that with you one-on-one. I can tell you that we're seeing more and more dealers being able to access capital, but obviously that's a combination of the financials that you heard Tom talk about, and it's going to be something related to portfolio performance and the value of the assets in question. So certainly we're always trying to help our clients position themselves to have a clean, healthy portfolio that does make sense for lenders, and we like to see borrowing ratios stay healthy so that it's safe for the lender and for the dealer borrower. So, it's something that we have experience with. But again, Luis, you and I can talk about that one-on-one. If you want to reach out to me, you've got my email address there on the screen. By all means, reach out to me, and we'll be happy to cover that separately. So let's make sure. I've got a few more questions. Let me read yours, Justin. Recommendation of how many accounts a collector should be able to manage. That's interesting. There's an industry standard on that about, so if I read his question correctly, if you guys heard me, he's asking, what's the recommendation in terms of how many accounts that a collector should be able to manage? I think you'd hear from the 20 groups out there and some of the industry people that number is about 300 per collector. And, because if I think about 300 customers and then you think about a 30% delinquency, that you're talking about roughly 100 accounts that they're managing, on any given time. And hopefully they don't all require management. But I've seen dealerships with much higher number of accounts per collector and doing just fine. But I think that number's shifting a little bit, as it depends a little bit on your underwriting, of course, and how many of your customers pay electronically or whatever other methods that you've got available for them to pay, as to how many customers pay through some sort of automated process. That's going to obviously cut down on the manpower needs, and so it can vary a little bit. But the short answer to your question is, they say the industry standard is around 300, and I've seen both sides of that, but that's probably a pretty good number to work from. Any other questions? I'm not seeing anything else on the panel. Well, appreciate the feedback and the participation. We'll go ahead and wrap it up unless anybody's got anything else. I'll watch the panel as we close up here. But again, we appreciate your participation. We would ask you to please consider joining. Email me, text me, call me on that number there if you want to participate in the the free December 31 analysis. Be a lot of great comparative information there. We would invite you to participate in that as well. But in the meantime, if we can be of service to you in any way, I should make a quick plug for our data services. We do ongoing analytics weekly and monthly for clients. So if you want to have us prepare, log into your system on Sunday, capture the data, send you summary reports on a weekly and a monthly basis, then be aware that we provide that service and reach out to us if we can be of service in that way. So again, I think that's it for today. I appreciate everybody tuning in. We'll wrap up and watch for your emails and hope to hear from you. Watch for us on Facebook and also the YouTube channel. We're starting to put more and more content out there on the Octane Group YouTube channel. So you're going to want to keep up with us over there as well, because we're sharing lots of specific content on that format as well. Again, thanks for joining in. We'll wrap up today.